Let's put the US and the OPEC data into perspective and the selling that we have seen in India. We have an expert joining us, Harold Vanderlyn, the head of equity strategy for Asia Pacific at HSBC, joins us on the phone line from Miami. Oh, good evening to you. Thank you so much, Harold, for staying up for us. Exactly.
Yes, good evening.
How should Indian investors look at the welter of data from the United States? Should it be immediately negative because bond yields went to 2.4, or is it ultimately positive?
Well, first of all, I hope you can hear me well, because as you said, I'm on the street corner, actually, in Miami here. How should we look at the data from the US? We've actually postponed our actual first rate increase from September to December over the weekend, because we think that, in general, the data that's coming through is actually a little bit disappointing. So we're worried that maybe the first rate increase is going to happen much later in the year than what we initially anticipated.
Why would the data disappoint you, Harold? I mean, the jobs data that came through on Friday was pretty strong.
Yeah, that's indeed correct. But if you look at a raft of other data, they've actually been a little bit disappointing against general expectations. Talking about earnings and some of the other reviews which has come through. So we think there's a bit of a risk. Also, the stronger dollar has a bit of an impact on the U.S. exports. And that could drag down growth a little bit. So we've actually just over the weekend changed our view and believe that instead of September, that the Fed is going to increase interest rates in December this year.
Okay, how should an investor into emerging markets, particularly India, interpret the global data events? Should we expect that because of the higher interest rates, higher rate on the US 10-year, we should see selling?
Well, we've been underweight India for a little bit of time now. So it's a market we honestly don't like at this particular point in time. That's not too much related to the US, although I would argue that if interest rates stay lower for longer, then on the margin, this will be positive for emerging markets as well, and that would not exclude India. That would include India in that sense. So that would be a positive. But we're a little bit more concerned actually on some of the domestic issues and the fact that everybody's overweight and the valuations are relatively high in India.
Okay, so since you are underweight on India, Harold, what's your view on what exactly is happening in India? I mean, we've corrected about 11% from our peak. Is this still a correction in an ongoing bull market?
I actually don't necessarily think so. I think we're going to see a little bit more of correction in India. The focus very often is on the reform side, and I don't disagree with the fact that with low real interest rates and some reform taking place, that the investment cycle should recover in India. But first of all, I think that the pace of the recovery in the investment cycle, as well as the pace of earnings growth in India, will disappoint. We've already seen that some of the earnings coming down. But to be honest, the most important fact for me, while we've gone cautious on India, has got to do with interest rates. We just don't think that interest rates will come down as fast as what the market was initially at least anticipating.
Okay. So do you see much more downsides?
Yeah, I believe there's further downside actually to the Indian market. We're only just starting to digest that interest rates are not really coming down. The risk really is that your CPI inflation is still above the target which the RBI wants to move to, which is about 4% by the end of next year. That means that they have to keep it relatively tight. And of course, an obvious risk factor is the possibility of food prices in El Nino coming through. And as the RBI indicated last week, that they want to wait until the end of the monsoon before they have a clearer view on food inflation before they make any other further adjustments to interest rates. And we have a similar view that for the moment, the interest rates really don't provide any support to the Indian equity market. Reform is a bit slower than what initially was anticipated. But there is downside risk, but the expectations were high and we're not really meeting them.
Okay, so what is, finally, just one last question from my end, Harold. What is your own view on global equities, given that you expect the Fed to raise rates in December? Up until then, do you think liquidity will remain benign? And if yes, which markets do you prefer, if not India?
At the moment, I mean, the market's anticipating that either September or December, and I think the market is maybe focusing a little bit more on September data at the moment. But we'll get better clearance on that, what is it, 18th this month when the Fed has their regular meetings. What is maybe more important is that we see already an unfolding of some of the positions in the global bond markets taking place, and local and long-term bond yields are moving higher. What that means for emerging markets in general is that that's probably not too positive. And if we see a stronger dollar, that might also not be too positive for emerging markets in the very near term. So, yeah, all around, I would say people are cautious on emerging markets, although for global investors, and as I said, I'm in Miami, I'm actually talking to global investors here in the US. A lot of them see good value in emerging markets as against some of the other markets. I would say in general people are cautious on the US markets, generally bullish on the European markets, where good earnings growth coming through, and macro data is surprising on the upside. There's obvious event risk taking place with Greece in the very near term. But aside from that, people are quite bullish on Europe. And I think people, in particular global investors, are willing to rotate into emerging markets. But we need to overcome some of the macro issues, which is more related to forex risk and the divergence between lower interest rates in emerging markets and higher interest rates, in particular in the US.
Fair point. Thank you very much, Harold, for staying up for us. Okay, that's not a particularly strong view on India, and I guess that's corroborated by the numbers as well. Agam has just sent me the collated numbers for FII selling in equity and debt in May and June, and that looks rather bad. It's about a 10,000 crore or 9,000 crore sale in debt from May and June, and about a 6,000 crore sale, or even a little more, 7,000 crore May and June put together in equity. I mean, obviously they've sold off more debt than they've sold equity. That's because the US yields went up. But all told, it is still a move of taking money out of India.